While the public focuses on chatbots and apps, a multi-trillion-dollar construction project is quietly taking place in the physical world. For decades, the image of a successful hedge fund involved algorithmic models fighting for trades measured in milliseconds. Today, the most aggressive funds are looking past the software layer. They are moving their capital into the physical requirements of AI, the data centers, the AI semiconductors, and the power grids. This strategy focuses on financing the physical racetrack rather than betting on which software horse will win the race. This shift places these funds at the center of the technology sector's physical supply chain. AI workloads demand a total reconstruction of our digital infrastructure. The scale is staggering. McKinsey projects meeting AI demand will require $7 trillion in data center investment by 2030. We see a similar trajectory in the broader infrastructure market, growing from $76 billion in 2026 to over $223 billion by 2030. This massive spending is creating a new class of physical assets for Wall Street to manage. Because the capital requirements are too large for tech companies to handle alone, a financing gap has opened for private investors to fill. Hedge funds use a four-step capital flywheel to capture this value, beginning with the tech giants themselves. It starts when hyperscale tech companies announce massive capital expenditure plans to build out their AI capabilities. In step 2, this spending flows directly to the hardware supply chain. Funds capture the initial gains by trading the stocks of the companies building the chips and servers. These wins attract fresh capital from global investors. By mid-2026, total hedge fund assets reached a record $5.6 trillion. Goldman Sachs data shows in the first half of 2026, these funds delivered 7% returns, significantly higher than the 10-year average. In step 4, the cycle completes. Funds take this pool of investor capital and recycle it back into the AI ecosystem through private debt and infrastructure deals. While traditional banks are often slowed down by rigid lending requirements, these complex infrastructure projects need capital quickly. Hedge funds act as direct lenders, using private credit to bypass banks and target an $800 billion financing gap identified by Morgan Stanley. This process turns hedge funds into the primary financiers for data center and power grid construction. However, relying on this flywheel introduces systemic risks. The primary danger is concentration. When the largest funds all crowd into the same deals, the market becomes sensitive to any shift in AI demand. The leverage used to fund these massive projects can amplify returns, but it also creates the potential for rapid losses if the projected demand for AI services fails to materialize. To follow the capital flows and the mechanisms shaping the markets behind the daily headlines, subscribe and hit the notification bell. This build-out shows that the AI boom is a massive industrial project involving concrete, fiber optics, and silicon. On Wall Street, power is shifting toward the financiers who are underwriting the physical world this technology requires.